The S&P 500 has officially dipped into correction territory, meaning the price has pulled back roughly 10% from its recent highs. There has certainly been a ton of carnage at the top of the index, with the likes of Apple, Microsoft, Nvidia, and Tesla really struggling. And when we're talking about an index that is market cap weighted, when you have stocks at the top that are struggling, it can bring the whole ship down. However, although there is a lot of uncertainty around tariffs, economic growth, how the job market is going to react, what is the Fed going to do? Plenty of uncertainty to go around. But history shows that when we do in fact enter into a correction, that is typically a good time to nibble. Looking at this chart here, you can see the corrections over the past 20 years and how the index has fared 12 months later. Only 2 times did we end up negative, which tells you how now could be that good time to start entering some positions. And notice how I mentioned nibbling earlier. We don't want to back the truck up, as there are still those uncertainties out there in the market, but we also don't want to try to time the market exactly. We prefer time in the market. And there's plenty of stocks out there that are still trading at great valuations, and some that are getting close to entry price points for me. As such, in today's video, we're going to be going through 7 stocks that are high on my watch list to buy. But before we unveil all of these, do me a huge favor, simply show your appreciation by clicking that like button down below, subscribe to the channel, and let's jump into it. Hey everyone, Mark Rusin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks to buy right now. All right, let's jump back into our video, quickly taking a look at 7 stocks that are high on my watch list to buy. Beginning with stock to watch number 1, which is going to be Bank of America, stock ticker BAC. When it comes to Bank of America, they are one of the 2 largest banks here in the US, the other being that of JP Morgan. Well, a lot of people like to invest and have invested in JP Morgan for a number of years, but if you put both of these banks up today, side by side, and they were trading at the exact same valuation, I would choose Bank of America. I like the CEO, Brian Moynihan. I believe he's a great leader, and he is going to have this company pointed in the right direction for the long term. The company currently has a market cap of $311 billion, and their 52-week high price point was roughly $48, meaning that the pullback from those highs now has the stock down 15%. Heading into a Trump 2.0 presidency, one of the sectors that is expected to benefit the most is going to be financials. Why? Because of less regulation. Financials for a number of years has been one of the most regulated industries in the market. Sometimes rightfully so. We can go back to the great financial crisis. But now with less regulation, that should impact in a positive manner in the near term the financial sector, big banks. Another reason to like banks is that I believe that the M&A activity is really going to pick up in the back half of the year. And then turning our attention to the near term, right now we have interest rates that are still at an elevated level, and they're expected to stay higher for longer, which is going to impact banks in a positive manner. Because why? They are going to have more net interest margin, which is going to be the difference between the amount of income that they bring in from loans compared to the amount of money that they send out by way of savings accounts, money that is paid to you for savings accounts that you have. Anything in between is considered net interest margin. Right now, shares of BAC trade at a price to earnings multiple of just 10.7 times. But with banks, I prefer to look at price to book, where shares of BAC currently trade at just 1.05, and anything below 1 is intriguing to me when it comes to Bank of America. The bank also pays a solid dividend that yields 2.6%, and they have a 5-year dividend growth rate of 8%. And management has grown the dividend for 11 consecutive years and counting. Looking now at tip ranks, where we can see that analysts have an average 12-month price target of nearly $53 per share, implying roughly 30% upside from current levels. And that brings us to stock to watch number 2, which is going to be Taiwan Semiconductor, stock ticker TSM. And when it comes to Taiwan Semi, this is a name that we've talked a lot about on my weekly live show, Stock Market After Hours, every Wednesday after the market close. And this is probably going to be one of the easiest buys on today's list because I like the valuation where it's at right now. As I've mentioned before, when it comes to investing in TSM, you don't have to worry about picking a chip winner. NVIDIA, AMD, Qualcomm, Broadcom, or Amazon for that matter. Taiwan Semi generates and manufactures most of the chips for all of these companies. The company currently has a market cap of $903 billion, making it one of the largest in the US markets. Their 52-week high price point was $226, and the pullback as of today has now reached nearly 25%. Ever since the DeepSeek news that came out of China, anything AI or chip related has really been under intense selling pressure. But I believe it's really overblown when it comes to Taiwan Semi because when you think about the DeepSeek news, it wasn't about how many chips we need. It was more about, do we actually need those super high powerful chips or could we use less powerful chips? Taiwan Semi isn't really focused on creating powerful or less powerful. They're going to create more capacity. And that's what we need more of, more and more chips, meaning Taiwan Semi is going to win no matter what. Now, when it comes to risk, it's not to say that Taiwan Semi has no risk because obviously AI spending can come down. We have plenty of geopolitical concerns. And of course, China looking to take over Taiwan are all risks to be aware of when investing in Taiwan Semi. Right now, shares of TSM trade at a price to earnings multiple below that of the S&P 500 at just 18.9 times, with EPS growth expected to be around 29%, giving shares a PEG ratio well below 1. Let's say those growth estimates are in fact too high. The company could miss these estimates by 15% and still be trading at a PE multiple right at their 5-year average. The company also pays a dividend that yields 1.4%, but not known much for the dividend as it only grows at an average rate of 3% roughly. Now taking a look at the tip ranks where we can see that analysts have an average 12-month price target of nearly $248 per share, implying more than 40% upside from current levels. And that leads us to stock to watch number 3, which is going to be Amazon, stock ticker AMZN. Now, this is not a stock that's new to this channel because I put out recent videos as of last year making Amazon one of my top stock picks. This is a name that I love to invest in and believe that the future is so very bright. This is a company that I've gone through and pounded the table on when it was trading at 170, and then I said, let's pump the brakes as it crept up to $240. Now, how did I know to buy at one level and how to not buy or sell at another level? That's simply going through my valuation checklist. I continue to look at stocks from every different angle. And this valuation checklist is something that I go through within my 6-week investing accelerator course, something that you can check out in the link down in the description below. Amazon currently has a market cap of $2.1 trillion, making it one of the largest of the top 10 companies here in the US, and their 52-week high was $242, and the pullback now is sitting at nearly 20%. Amazon is one of those companies I love for a number of reasons, but one of the primary reasons is due in part that they have a diversified portfolio, meaning that if one area of the business is slow, there's plenty of other areas of the business that can pick up the slack. And when you think about Amazon, you don't just think about e-commerce. They also have cloud, advertising, digital, subscriptions, and yes, even AI. Amazon has been investing heavily and backing AI startup company Anthropic, which recently went through a round of funding that valued the company at more than $60 billion. Amazon has invested $8 billion in the AI startup company as a minority partner, and those investments are now worth $14 billion based on the latest valuation. Right now, speaking of valuation, Amazon shares trade at a PE multiple of 30.6 times, briefly falling below 30, which is not something we have seen. But again, this is a high growth company. And if you look at their EV to EBITDA, a metric that I love to look at, this is one of the cheapest points you've ever been able to buy Amazon at. Analysts are also upbeat on the stock as they have an average 12-month price target of nearly $270, implying more than 35% upside from current levels. And a look at the lowest price target of all analysts is sitting at 203, which is higher than today's closing price. That should tell you right there and give you a little bit more confidence as an investor. I will continue to look for opportunities to buy more Amazon at under $200 and even under $185 if we can get that low. And that leads us to stock to watch number 4, which is going to be the Home Depot, stock ticker HD. Now this might be an interesting name, one that you may have not expected. But HD, or Home Depot, has been a stock that I have loved for a number of years. And I owned it up until the pandemic back in 2021 when it went through this massive boom of home improvement and the stock price skyrocketed. At that point in time, I sold out of my shares. And looking back, always hindsight is 2020, it proved to be a great decision. But now that we've gone through a lull period for Home Depot, interest rates have been high, which has kind of weighed on the real estate sector as a whole. I'm expecting those interest rates to slowly but surely come down. And at the same time, we're entering the very important spring selling season, which typically bodes well for both real estate and Home Depot alike. The company currently has a market cap of $349 billion, and they reached a 52-week high of nearly $440, meaning at today's price point, we are sitting at a pullback from their recent highs of roughly 20%. Home Depot has long been the clear leader when it comes to home improvement. Their close competitor being Lowe's, and Lowe's has done a fine job closing the gap that was once very large. And you could really not go wrong with either of these companies heading into the spring selling season. But I have long loved Home Depot. In fact, I've owned both of these companies here, but they have been well known for their dividend, not only paying, but having strong dividend growth rates. And now heading into the spring selling season, after a few years of negative comps, those comps now are going to be a benefit to Home Depot because the stakes aren't as high and they're going to be a little bit easier to beat those last year comps. And I also think the home improvement, after going through a massive boom during the pandemic, can creep up again, especially if we see interest rates come down. So again, this isn't a name that I'm going to be backing the truck up into. It's just a name that I want to start nibbling at the right price. Looking at the chart here, we can see that that 320 level is the next level of support for the stock. And we currently have an RSI sitting all the way down at 27, which is intriguing, indicating that shares are currently oversold. In terms of valuation, right now shares of HD trade at a PE multiple of 23, which is right in line with their 5-year average, which is also why I'm not rushing to buy stocks at current levels and why this stock is on my watch list. But a price point around $300 is the ultimate goal, as that is an area that I would like to add, as it would put shares at a 20 times multiple, meaning a great entry point. The company is long known for being a strong dividend grower. Shares of HD currently yield a dividend of 2.7%, and they have a 5-year dividend growth rate sitting at 10% and 15 consecutive years of dividend hikes. Looking now at tip ranks, we could see that analysts have an average 12-month price target of $450 per share, implying nearly 30% upside from current levels. Some of these stocks that we're talking about today are already within my portfolio, and I'm looking to add to them. But some of them, like Home Depot that we just mentioned, is not in my portfolio. And if you're interested in seeing all of the stocks and ETFs within my portfolio, then consider becoming an Edge Plus subscriber within my Stock Investors Edge newsletter. Not only do you get trade alerts and my monthly portfolio, you get weekly deep dives, earning recap, and giving you an Edge report that will set your week and give you direction in the week ahead, and so many more perks. But there's going to be a price hike coming in April 1st. So if you're interested in joining and becoming an Edge Plus member, do it before the price hike. Lock in the current rate today. And you can do this by checking out the link down in the description below. And that's going to lead us to stock to watch number 5, which is going to be Prologis, stock ticker PLD. You didn't really think that we were going to go through 7 stocks today and I wasn't going to mention a REIT. You know that I love talking about and investing in REITs. And Prologis is probably one of my favorites. This is another position that's already within my portfolio, but also one that I would like to add to at the right price. REITs are one of the easiest ways for retail investors to gain exposure to the real estate market. You don't have to worry about locking up thousands for many years by investing in private real estate. This doesn't go to say that investing in private real estate is not a good route, because there's pros and cons to both ways. And when it comes to Prologis, you are gaining a portfolio of warehouse and industrial properties. The company currently has a market cap of $104 billion, making it the largest REIT on the market, and it reached a 52-week high price of $132 and change. Today, at current prices, the pullback from that high is now reaching more than 15%. REITs for the past 5 years have been the worst performing sector. But if you go back all the way to the 1970s, you will see the data shows that the REIT sector has long outperformed the S&P 500 from a total return perspective. You get share price appreciation and usually strong dividends to go with it. And investing in real estate is yet another way to diversify your portfolio. And when it comes to REITs, REITs are interest rate sensitive. So for the past 5 years, we have had sky-high inflation, which has led to the fastest increase in interest rates that we have seen in modern history. So for an interest rate sensitive sector like REITs, this did not bode well. But what is on the horizon? Lower interest rates, which is going to have REITs breathing a sigh of relief, and we'll start to see, which we've already started to see a little bit, of investors creeping back into the sector. Right now, shares of PLD trade at a price to AFFO of 24.2 times, which is well below their 5 and 10-year average of 27 times, indicating an intriguing entry point. However, I want to see those prices come down to around $100, which I believe would be another good entry point for me to buy more shares. REITs, as I mentioned, are also known for paying some nice sized dividend yields, but rarely do they offer much in terms of dividend growth. PLD, though, bucks that trend, as they have not only a dividend yield of 3.7%, but they have a strong 5-year dividend growth rate of 13% to go along with that. And they've been increasing their dividend for 11 straight years. Looking now at the tip rank screen, you can see that analysts have an average 12-month price target of roughly $129, implying nearly 15% upside from current levels. And that leads us to stock to watch number 6, which is going to be Block, stock ticker XYZ. So these final 2 stocks that we're going to look at here on our list of 7 stocks, these are going to be higher risk, higher reward type of options. They also come with a lot more volatility, and you're going to see what I'm talking about when we look at the charts here. And when it comes to Block, formerly Square, this is a company where it has seen revenues just absolutely explode. But the stock price, which once did explode, has completely fallen off track and is now trading back at 2018 levels. So what does this tell you? Although revenues are climbing at a rapid pace, investors are questioning the forward revenue growth. They don't believe what this company can do. The company currently has a market cap of $35 billion, and their 52-week high was nearly $100. They were knocking on the doorstep at $99. However, you can see today's price, where the stock has fell roughly 40%. It's been ugly for Block, especially considering most of the pullback has really taken place over the past month, when shares are down more than 30%. There are plenty of reasons to be excited and also concerned about Block moving forward. The first to mention is their Afterpay business, which has been doing quite amazing. However, this is a buy now, pay later type of program, so if we fall into a period where the consumer just completely falls off, that's going to put credit risk on this business. The other side of things, and this may be a positive or negative depending on how you look at cryptocurrency, is Block is yet another way to play Bitcoin or to play crypto in general. Right now, shares of XYZ trade at a paltry PE of just 12 times. This is on par with a slow-growing company like Altria Group, who's growing its earnings by just 3 to 4%. XYZ is expected to grow their earnings by 32% this year, 10x that of Altria, and 17% next year, meaning the PEG ratio is well below 1. There's plenty of risk, but it seems like a lot of it is priced in, considering the multiples across the board. Analysts rate the stock a strong buy with an average 12-month price target of $99 per share, implying more than 70% upside from current levels. Now, do I expect a 70% return this year? No. But I think this is a stock that has the ability to provide some sizable gains, but we'll have to see. And finally, stock to watch number 7 is going to be the trade desk, stock ticker TTD. And when it comes to the trade desk, if you thought Block was volatile, wait till you see the 1-month chart on the trade desk. And for those of you unaware, the trade desk can be thought of as a digital advertising company. They currently have a market cap of just $27 billion, and their 52-week high price point was over $140 per share. But at today's price point, which has come all the way down into the mid-50 range, has a pullback from recent highs of 62%. Those are brutal return numbers for those of you that have been shareholders for quite some time, or even more recently for Trade Desk. As their 1-month return in just 4 weeks, the stock's down 35%. Looking at 2025 alone, the stock is down 55%. This is a perfect example of a company when it comes to investing. It's less about what you did for me and more about what you're going to do for me, the look ahead. The company beat earnings expectations in their most recent quarterly report, but they did miss on revenues. However, it was the forward guidance ahead that sent shares tumbling down. And although those figures were not ideal, operating metrics remain quite strong, as the company has a 95% retention rate, and they're showing their ability to improve margins as we've seen profits increase. EBITDA margins sitting at nearly 50%, which is very strong. And finally, management announced a new $1 billion stock buyback plan, which hopefully management is taking advantage of at these low prices. Again, solid operating metrics, weak forward guidance as compared to analysts' expectations, but they've mentioned that they're going through a period of transition and that growth is expected to come back in the years to come, which you're going to see from the earnings expectations that I'm going to show you right now. Shares of TTD currently trade at a PE multiple of 30 times, but that is assuming just 8% earnings growth, which I believe the company can outpace. And as you can see here, the following years we see growth pick back up to 20% as well. And if you thought analysts were high on XYZ, check these figures out, as analysts have an average 12-month price target of $120 per share, implying over 120% upside potential. And you might think to yourself, well, these are probably just some stale estimates that haven't yet been updated. But look here, you can see that these are analysts that have reiterated their calls this month alone. So there we just went through 7 stocks that are high on my watch list. Some of them I already own in my portfolio. Some would be brand new buys. But I'm not necessarily looking to jump into all of them right away. And I'm certainly not going heavy into them given the uncertainty in the market. But as we saw at the beginning of this video, anytime we hit a correction, that's usually a time to put at least some money to work. Down in the comment section below, let me know which of these 7 stocks do you like the best, would be highest on your watch list this particular month. And if you haven't done so, click that like button down below, subscribe to the channel, and we'll see you in the next one. Take care.